Worried how a new US move on Russian oil could hit your portfolio? Here's what the temporary leeway to buy cargoes already at sea means for energy prices and markets. Washington has greenlit a short window to purchase Russian crude that's already in transit. This does not rewrite sanctions. It is a narrow, time-bound fix to clear stranded barrels and smooth seaborne flows. The goal is simple: keep near-term supply from seizing up and prevent a fresh spike in oil prices. Sanctions have left some cargoes hard to trade, with insurers, banks and shippers stepping back. That creates bottlenecks and raises the risk of distressed barrels. By allowing transactions only for oil currently at sea, officials are addressing a choke point without opening new business. The stance on broader restrictions remains intact. Compliance checks and eligibility verification still apply. If those stranded shipments move, prompt supply improves. That can ease physical market tightness, calm time spreads, and soften volatility in benchmarks. Refineries benefit from steadier feedstock access and clearer delivery schedules. Producers could see slightly lower realized prices if prompt scarcity fades. Credit conditions tied to shipping and trade finance may stabilize as uncertainty recedes. Crypto is not a direct channel here, but shifts in inflation expectations can still ripple into risk appetite. This is about market functioning, not policy reversal. The clock is ticking, and traders will watch how fast cargoes clear, how freight and insurance quotes respond, and how inventories rebuild. Even small gains in seaborne flow can influence refinery runs and product output, shaping gasoline and diesel margins. For inflation and rates, the link is straightforward. Energy is a major input for consumer prices. Preventing a short-term oil spike can reduce pressure on headline inflation and, by extension, on central bank rhetoric. It does not change medium-term supply dynamics or the larger sanctions framework, but it can dampen near-term volatility that bleeds into bond yields and equity risk premia. What should investors do now? Focus on prompt versus deferred crude spreads, refinery margin indicators, and shipping rates. Watch integrated oils and refiners for diverging effects on input costs and realized prices. Revisit hedges if your exposure leans toward short-dated energy sensitivity, and keep compliance risk in view. This window is narrow and temporary. Bottom line, this is a targeted release valve for logistics, aiming to steady prices without diluting sanctions. It may trim volatility and ease inflation nerves, but it is no game-changer for long-term supply. Read the full article at finlitica.com.